Welcome, my friends, to another edition of the Heritage Wealth Planning YouTube channel. This can be just part two of some of the blog posts I've made over the last 6 months or so that I find pretty interesting and informative, actually. Yes, a little bit of self-promotion here for you to read my blog. But again, as a visual learner, sometimes people learn better visually or through the word, through me talking as opposed to just reading something. Sometimes people learn better by reading it. And sometimes people look better by visualizing it. And I'm all three. Sometimes I listen to a podcast and I'm like, oh man, sometimes I need to actually visualize it and sometimes I can read it. So what I try to do is I try to give I don't have a podcast yet. Maybe at some point I will. But I like the video channel concept because I think it can allow me to share with you some informative information that I think you might find valuable, actually. Today we're going to talk about the Morningstar 5-star ratings. Morningstar, I don't know why, but some folks give it a bad rap, say that you shouldn't judge a fund by the 5-star ratings and all that. And frankly, I get that. The issue is that Morningstar itself doesn't sit there and say, oh, our 5-star fund ratings, move the clouds for Morningstar is coming through their ratings. They don't do that. They do a very thorough, very unbiased analysis of funds, and they give them ratings based on a bunch of different metrics, which I won't get into too much detail here. But what I do like about Morningstar is they don't just stop there. They actually look to see what the history has been on the ratings of 5-star funds. And that's good. So that's fair because not only are they saying this is what we say you should do, but they're saying this is what happened if you did this as opposed to just pretending it didn't exist. And if you've been around at all, and I have been, you'll remember in 1999, folks who are now touting various investment schemes or touting various investment schemes back then, and a lot of people went bankrupt. 2007, no one was predicting the market to go down. No one did, and yet it did, and yet the same people are still touting the same investment prowess as if they have it. I just don't get it. Whereas Morningstar, on the other hand, will say, we're going to research what we've shown you, and you can do your due diligence there and make a decision based on that alone. And I actually like that quite a bit. So I'm a fan of Morningstar. I am not a fan at all of the various mutual fund companies, though, touting their 5-star funds. It actually drives me crazy because these same fund companies, and trust me, I've been there. I've seen these companies as in my previous employ, will say, look at our 5-star funds, as if that means that I just hate that, because essentially what they're saying is 5-star funds are what you should invest in and nothing else. And there's some validity to that. I'll show you here in just a second, but it's not that much, frankly. And so if you're going to tout your 5-star funds and that fund falls on hard times, and then you're going to tout another 5-star fund because the 5-star fund that was it became a 1-star, and now the 1-star fund is now a 5-star. I mean, it's back chasing. You're chasing performance, and you shouldn't do that. One thing I know for a fact in investments, there's a fund called the Legg Mason Value Trust, and let me just hear me out for a second. The Legg Mason Value Trust was the only fund to have beaten the S&P 500 for like 15 years in a row. A guy named Bill Miller ran it. He was the cat's meow, and all these mutual fund companies' websites and all these financial magazine, the front cover, is a guru, Bill Miller this, Bill Miller that. And to his credit, he said it's luck. I mean, he said, I just happened a couple times to get lucky on the last day of the trading year. He didn't say it's because I'm so smart. And then in 2007, going into 2008, the fund just took on a chin and got hammered. And literally within 18 months' time, what was previously a 5-star fund rating went all the way down to 1-star. The same guy's running it. So the previous 15 years, Bill Miller beat the S&P 500 every year. No one else even came close. The 18 months later, he couldn't get a free cup of coffee at McDonald's. It's crazy. Now, he's still in the business and all that, and I don't know what he's doing anymore. He's running money. I just don't know how well he's doing it. But it just shows you that, how quickly things change. For a 5-star fund can just have a bad year and suddenly be falling, the 1-star fund, and then everybody hates it. Whereas those same people were loving it 18 months previously. It's just, it actually is annoying to me. All right, so let's just show you. But one of the things I do like about 5-star funds And this is my blog post, joshscanlon.com. Again, I haven't moved this over yet to Heritage Wealth Planning. I'll probably do that here today when I get off the horn here. But anyway, one thing I love about Morningstar is that they analyze their own rating system. They actually give us the results of what the rating system shows you. And I think that's pretty interesting. First thing to understand is only 10% of the funds actually get 5 stars. All right, 10% of the funds, that's it. So a very rarefied air. Now, the problem with that for Morningstar is because it doesn't take much for one or two. We'll go back to Bill Miller. Bill Miller falling off a cliff like it did from 2007 to 2008. He's just one of the 10% that get the 5-star. If one of those funds happen to go kaput, that's going to make the whole Morningstar constituents of 5-star rated funds is going to suffer the performance across the board. Even if it was all attributed to bad performance, all attributed to one guy, it's going to make all the rest of the survivors look bad simply because that one guy just got hammered. And that's the thing when you're starting to deal with less and less diversification, more and more concentration is that, and this is the thing with diversification on your own investments. The less diversified you are, all it takes is 1 or 2 bad apples and your goose is cooked. Same thing here with Morningstar. Only 10% of their funds get 5-star ratings. So if they have 100 funds with 5-star ratings and 90 are kicking butt and taking names, and then 10 fall off a cliff, it's going to be awful hard to overcome the overall track record of those 5-star funds because those 10s just fell off a cliff. Does that make sense? I hope so. Just remember, the more concentrated something becomes, the more likely it is for that concentrated portfolio to fall in hard times, not because of the overall concept of the portfolio, but just 1 or 2 bad actors can really hurt you badly. And I think that's actually happened a little bit with Morningstar, but that's not the end of the story. What I love about Morningstar is they adjust for survivor bias. Folks, if you don't, look, you can think I'm full of hot air. I don't care. Survivorship bias is incredibly important to understand in investment world. In fact, I give you an example of a sports team. I'm not going to read this verbatim, but just go back and look at how a league with 10 teams and one team folded, and just read my little anecdote here. I guess, is it an anecdote? Yeah, I think so. Read my little story here, if you would. I'm telling you right now, survivorship bias is hugely important to understand, because the bad guys don't survive, the good guys do, which inherently makes the good guys look better on average. Makes the good guys look better. As long as you survive, it'll make you look better than average, because the bad guys fold up and they go kaput. And I use an example, if you like football, about an NFL survivorship bias and how that could affect the NFL teams as a whole. Morningstar also analyzes risk-adjusted returns. I'm telling you, I remember, you might not remember, back in the late 90s, everybody, the internet fund, Janus funds, everybody was going for large cap tech stocks, growth, value. I'll never forget, I was working at Vanguard, and I think the manager of the Windsor fund was named Bill Neff or John Neff. Bill or John Neff, I can't remember, Mr. Neff. And this guy has been around since 1967, just taking money, making money, kicking butt, taking names, good markets, bad markets. This guy was just a great fund manager, but he was large cap value stocks with dividends, low valuations in terms of price to earnings ratios and things of that nature. Slow but steady growth. Just a wonderful fund manager. But then in the late 90s, people want him fired. They said he lost his methodology, and basically like they said about Warren Buffett. And I'd never forget this. I remember I used to work at Vanguard. People would call in and say, they got to fire that guy. He stinks. I want to go to the Capital Opportunity Fund or the Small Cap Growth Fund. I remember it was like yesterday. And those people got killed. When you look at the market history from 2000 and 2001 and 2002, everybody always focuses on the S&P 500. S&P 500 was down 9, 11, and 22% respectively. But that's not the whole story, because a lot of people had large cap growth stocks. The S&P 500 is value and growth stocks combined. So if you're only focused on the S&P as a whole, the value stocks, which didn't get pummeled nearly as much, if at all, they allowed for that 22% to look. They basically allowed for that 22% to look not as bad. But if you're on the growth stocks, which most people were, you would have loved to only been down 22%. You would have been down. You're saying to myself, I had everything large cap growth. I didn't lose just 22%. I lost 80%. But because the large cap value was there to rescue the index as a whole, it was only down 9, 11, and 22% respectively. But that is not true for a lot of investors who had everything tied up in crazy stuff like the internet fund and Janus. Horrible. I saw it with my very own eyes. So anyway, so that's risk adjusted returns. If you throw all your darts at one target, if you hit the target, you're multimillionaire. But if the moving target and you keep missing, at some point you're going to run out of darts. And when you run out of darts, there's no escape. You're dead. You're done. You're doomed. You have no money left. And that's exactly what Morningstar analyzes. Are these heavy hitters today because they're taking a lot of risk, i.e. a very concentrated portfolio, or are they heavy hitters because they actually have good stock picking prowess? And that's what they're looking at, which I love. They also adjust for various share classes. And here's an example of American funds. I'm a big fan of American funds. American Fund Income Fund of America. And I look at the difference between the Class A share with a front-end commission versus the Class C share, which doesn't have a front-end commission but charges 1% more a year. And the red is the Class A with a front-end commission. The black is a Class C. And you can see a pretty significant difference between the two. And the Morningstar analysis adjusts for the different share price, the different fee structure on various share classes. And I love that a lot because over time, that's a big deal. The facts are a front-end commission is not the worst thing that you ever paid. I'm just telling you right now. It's just not. It doesn't mean it's good, doesn't mean it's bad. It just means it could be good, it could be bad. It just depends on your circumstance. Either way, Morningstar takes that in consideration. Now, here's the kicker. Morningstar 5-star funds do outperform, but not by much. All right, and this is from Morningstar's own talk. They say, our findings suggest that 5-star funds outperform 1-star funds by approximately 25% point analyzed on average across multiple holding periods and market cycles. So that's not much. A 5-star fund that you bought today or that you bought 10 years ago would have outperformed the 1-star fund by 25 basis points or 1/4% across multiple holding periods and market cycles. And they even say longer-term event study results further suggest that on average, investors who bought higher-rated funds have tended to earn higher returns than those who purchased lower funds, though the magnitude of this outperformance is low. So again, they're saying that there's been small outperformance of higher-rated funds, and here's why. The reason for that is likely caused by the star ratings' high correlation to fees. High correlation of fees. So the higher rated funds typically have lower fees. The lower rated funds typically have higher fees. And thus, not fund manager per se, it's the fees the fund manager charges. Now, over time, these differences accumulate in economically significant ways, which I'll show you here in just a second. Ultimately, at the end of the day, what Morningstar is saying here is that they can attribute it to fees. That's literally cut and dry as the fees. And I say that right here. Now, the interesting thing is there is a short-term bump. So what happened? Interestingly, too, is that as the time period expands, the outperformance of higher-rated funds declines. There's a short-term bump when the fund becomes recognized as a 5-star rating. So it gives a little bit of a jump, and then it starts slowly, gradually coming back. Gravity starts pulling it back to average. What is the reason for that? Well, simple. Just like a stock that's put in the S&P 500, it's going to get a short-term bump because of demand. People got to buy it for their index funds. They got to buy it because it has new marketing behind it. In terms of like, oh, that stock is in the S&P 500. That must mean it's good. Just anytime you get a reason to buy something, people are going to do it. They say track record historically, even though it's supposed to be insignificant or not meaningful, people still do that. And same thing with Morningstar. If Morningstar puts his blessing on a 5-star fund, all of a sudden people are going to want to buy that 5-star fund, and you'll see a jump in the short term, which will dramatically decline significantly, but it'll still outperform in the long run. Now, here's why you should buy Morningstar funds. Fees, what I just talked about. Basically, what they're saying is the reason our outperformance comes down to is fees. All right, so that's all there is to it. Here's an article from French and Fama. If you ever heard of Dimensional Fund Advisors, DFA, these are the academics behind DFA's target, where they're focusing more on value as opposed to just a pure capital index like the S&P 500. They're doing more value approach, the factor methodology that these guys use. They've been studying for many, many, many years. And they say the high management fees and expenses of active funds lower their returns. It's really, I don't think that's a debate much anymore. Here's another in the Wall Street Journal. As I've read previously, the single most reliable guide to selecting actively managed funds that will generate risk-adjusted performance is low cost. I mean, again, this guy who wrote in the Wall Street Journal is saying that you don't even need Morningstar to figure that out. I disagree with that. I mean, if I can see Morningstar, the 5-star fund, just very quick and visual, or I got to dive through the Wall Street Journal mutual fund charts, I'd rather look at Morningstar, because Morningstar is doing the same thing anyway. They're saying at the end of the day, the reason for the adjusted outperformance is because of the fees. That's what they're saying. And Morningstar itself talks about I have lots of links in this article, and I'll link to this article in the show notes. The expense ratio is the most proven predictor of future fund returns, folks. The expense ratio. Now, my previous video on this topic about expenses, I just talked, I'll link to it right there. That's why I'm doing that. As we talked about expenses, but also trading costs are part of that, but they're not part of expenses. Trading costs are significant, but you can't see them. And I gave you some examples of what you could do to look at trading costs relative expense ratios. Combine the two to get a good gauge of what the fees you're going to pay would be. The first and foremost one would be the expense ratio. You can see right on Morningstar's website what's the expense of a fund. And again, the example I used in that video last time was the Fidelity Magellan was 0.65. The average fund is 1.18. That's a pretty significant difference there. All right. Longevity. And again, going back to the survivorship bias, 5-star funds were also more likely to survive a full event study horizon than lower funds. So essentially, the Internet Fund is no more, but Fidelity Magellan still is. Just give an example there. The Windsor Fund is still around. Those Janus funds and Forehand funds. I remember Forehand. I don't even know what those folks are. I don't think they're even still around. Janus funds changed methodology greatly, and they're a minor player now, but back then they were huge. And this is it. The 5-star funds did not suffer from survivorship bias. They stayed. They're still active. Other funds are not. And that's a huge thing. And lastly, outperformance. The facts are the average Morningstar 5-star fund did outperform by 25 basis points. And like I say in my article here, if we each put $100,000 in a fund and I got 5.75 on my returns and you got 6% on your returns, you'd have $5,000 more in your account than I would. I mean, that's real money. And that might not seem like much, but $5,000, I mean, shoot, that's a trip to Italy or something like that. And that's real money. So just going on Morningstar's returns, it would have been more risk adjusted, more likely to survive than your fund, and outperformed as well, and have lower fees. I'll take that. Absolutely. I'll take that any day of the week. I would have had more money than you. And so Morningstar, and this is from them, they reward longer-term performance, low volatility of returns, low fees. What can you ask for? So using Morningstar's highly rated funds, they reward longer-term performance, i.e. the funds that they give good ratings to are still around. They don't go kaput. Lower volatility of returns. So they're more stable, less up and down, and low fees. So outperformance, lower volatility, and lower fees, that's win-win-win in my opinion. Even if you're only getting a little bit of performance bump, it's still better than nothing. Lastly, when it comes to bond funds, there's no debate. Fees are the predominant thing on bond funds. There's just no debate about that. So Morningstar 5-star ratings for stock funds, we can debate toward the blue in the face. Maybe 25 basis points is not enough for you to say Morningstar. On the bond side, you're wrong if you think that. Morningstar 5-star rated funds on the bond funds are specific to just what we talked about. Longer term performance, low volatility, and lower fees. And the likelihood of a high fee rated fund on the bond side outperforming a low fee rated fund is exceptionally low And frankly, the only way you can really do that is by leverage, taking on a whole lot of risk. There is just not that much opportunity for prowess on the fixed income side, the bond side, when you're facing high fees. They're just not. So if I'm looking at a bond fund, I'm going right away to Morningstar 5-star ratings. Absolutely. Without question, without qualification. Stock funds, maybe not. I still would, but you don't have to. But bond funds, absolutely. All right. Hope this helps, guys. I do think Morningstar is worth your look for sure. Certainly better than diving into Kiplinger's or all these Wall Street Journal stock pay. I mean, my goodness, just make your eyes glaze over. Just buy a 5-star rated fund. Make sure you're diversified and just sit on it, and you'll be just fine. You'll be just fine. All right. Comments, thumbs up. Don't forget to subscribe and hit that notification bell to be made aware of future content on the Heritage Wealth Planning website, YouTube channel. Thanks, guys.